Hello and welcome back to Property Matters on Dublin South FM and on iPropertyRadio with myself, Carol Tallon. You can contact us on social media at iPropertyRadio or email hello@iPropertyRadio.com. Joining us today is returning guest Robert Colleran of Robert Colleran Property Consultants, an Irish company that specialises in development land sales and, of course, commercial property. Robert, you're very welcome back. Development land, it's a hot topic at the moment.
Yeah, no, thanks for having me on again, Carol. Really appreciate it.
My pleasure. And in fact, before we started recording, I actually spoke to you, a little about development land because it is such a hot topic at the moment, but there's huge confusion. Yesterday, I was at an industry event where a very, very senior, two very senior figures in the industry were one made the comment about development land being so expensive and that being a prohibitive factor in development. And the other senior figure said, actually, no, development land is pretty worthless. And part of my job is telling developers development land is worthless right now in the current environment where we can't get planning. Everything is stuck for 2-3 months. And it was a really interesting perspective. I'd never heard anybody come out and say that about development land, but there's so much uncertainty at the moment. So tell me, how are you seeing things in the marketplace?
I think housing is still good. Housing is strong, especially if it's residential zoned land. Key is serviced. If it's well serviced, like the difference between housing and I suppose apartments is you can build as you go. Like you can build in tranches, so you don't have to build it all as one lot. Construction costs are lower. And then you'd like to think that you'd be more successful with planning. Whereas in terms of, I suppose, a lot of the apartment sites, it's really down to the cost of construction, and then it's kind of getting all the, I suppose, the architectural sign off for fire rating, and then as soon as you start building, you have to go and build the entire. Like I'll give you an example. I was involved in a site sale. It's still going through, but the site sale was building 98 apartments, and then between April and now, the cost of construction went up by 4 million. So,
and what's that in percentage terms on the?
I'm not too sure the overall percentage because I'm involved in the sales side. They're involved on the construction side, so I don't see their spreadsheet or their build out costs. But in terms of that, it was a significant uplift. So then what do? They have to go back to their funder with a revised costing to say, hang on a second, this isn't costing X, it's now costing Y, and can we tweak the plan slightly to cut it back so it could be kind of less basement space and change it through. But the reality is they got the funder to come back again. It's like getting a mortgage approval and then going back again and getting it changed. So that's the problem. It's more to do with funding and not necessarily the purchase, but the development of the project. And then a lot of developers are nearly trying to line up a takeout. So if that makes sense, so they need to buy a site with planning permission, or else do something where the deal is subject to planning permission. So, for instance, I have a site at the moment, and it's only a small site for 18 apartments, and their funding partner backed out. They had to get another partner to step in, and they're talking to approved housing bodies. So it'll end up being for social, but they need to line up that takeout. So it's de-risking it. So in a sense, they can nearly forward fund it, saying that, we're going to get X price per unit from DCC for X outfit. So it could be Peter McFerry, it could be to or Respond or Focus Ireland, one of these groups. So a lot of that is happening. Otherwise, like there's no one really. Well, there's very little build to sell because the cost of construction is just too high. So it's planning uncertainty, and then the risk. At the moment, construction costs, they haven't fully leveled off. They haven't started coming down yet. So everybody, if you're looking at a feasibility, you're looking at what's the cost now. So No, like if you're looking at layman's terms, like it could cost you, like a site cost could have been 90,000 for an apartment site in city centre. That could be down to 65, 70 now. So, then the land values have to come down. So what you were sitting on 2 years ago, you're now having to go back and say, well, the land value for the site now has to come down in line with construction costs. It has to be feasible.
There's so many factors at play here, and they're all kind of almost pulling against each other. So, like, just say the example of the one you were talking about there, the one for 98 apartments that went up by 4 million. Did you get any sight on what was driving up that 4 million? Like, was it materials? Was it any particular type of materials?
Yeah, it was mainly materials. So it'll be your timber, plastics, supply. Yeah, like your timber. It's probably delays in supply, timber, plastic, steel, all the rest. But also not only that, as I touched on, it's the sign off for the for the fire rating, fire stopping. Since Grenfell Towers, is so much stricter. That's kind of one of the main drivers there. But it's not just that; it's interest rates, it's inflation, it's build cost. So all of that combined with supply, like labor costs are up. I think it'll start coming down, but it hasn't started coming down yet. But maybe Q3, Q4 this year. You might see some price reduction in development.
You mentioned funding partners. Are the pillar banks, are the main banks lending for development at all at the moment?
They will, but it would be on the basis that the site has planning permission, and the site has planning permission, and maybe a takeout. But like your housing sites, they'll lend for those, but if you went to a bank with a site without planning permission, then you'd struggle to get for them to lend for the development of it. What they'd nearly do is you might have to go to an independent lender like your Lotus, Castlehaven, or somebody else, and they'd lend for a period of time till you got your planning permission. And then once you got your planning permission and had your I suppose your takeout, you'd go back to a pillar bank and maybe refinance it and look to do that. So
yeah, but from the sounds of it, even the pillar banks are only essentially working as bridging under another name. They're essentially only doing that if they see their exit, they see the buyers. So
yeah, they won't take on a site without planning permission. They won't fund development without that in place. It's too risky. And then, like, even at that, I suppose there's a big planning risk. Everybody's talking about NIMBYism, objections. If you look at the delays and the furore on board Planola, there were planning applications going on for two years or longer. Delays. Like I was involved in one for a co-living scheme. They got the co-living planning permission at the end, but it took so long. It was the guts of 2 years.
But I think it's frustrating. I think it's almost kind of an insult to the industry where you can be looking at an application that might cost collectively or altogether it might cost 1.5 million or thereabouts, and the delays, the penalty you're getting for those delays, 10,000, capped at 10,000. It's not fair. It's not adequate compensation for the delays that are being faced.
I fully agree with you. Like somebody could be on the line for building, a few hundred units, and they could be spending, 500,000, 700,000 euro to get a planning refusal. So if he got a planning refusal after spending over 500,000, you'd have to put that into your costing. And that could break somebody.
And the planning, I suppose I definitely don't want to dwell too long on this, because it just feels like over the last 12 to 18 months, every time we discuss planning, it is just, it's a basket case right now. Do you know what's happening in a board? It's almost farcical. Like, what's the feeling amongst your clients, the people who we depend on to deliver, whether it's residential or commercial? I mean, have they any confidence left in the planning system?
It all depends on the site, Carol. It kind of depends on the site and the due diligence. Like most developers will have their own architect, their own planning expert, and they'll give them a conservative opinion on it. And then what they'll do is they'll base their costs on the conservative opinion on it. But going for the extra few floors, nobody's going to back that and put a bet on it. You're nearly going to go on. This is what I'm sure I'll get based on what's in the area, what's beside me, what precedent is there.
Yeah.
But it depends. It all depends on the site, really. It's site specific, but generally housing seems to be good. And then sometimes I think what developers are nearly saying, in some cases, less is more. So rather than trying to fit as many apartments on a site as possible, they might go for a lower density scheme in some cases because it might be more profitable to build out. And then even like I sold a small site in Shankill, and then the purchasers decided to go for housing instead of apartments, given the cost of construction, given viability of it.
But I presume as well they're coming into a marketplace where they know the demand is very, very strong, and
it's extremely strong for housing. Like your housing supply is at an all-time low. What's nearly better are the commuter belts. If you look at the big, your Glenveaghs, your Cairns, they're going for the outskirts or commuter belts, and then they're going for a price point. The minute they build, they'll have people. They can pre-sell off the plans. If you're in around the commuter belts, you can nearly have it pre-sold.
Yeah. Okay.
For housing in particular, like the apartment sales, second-hand apartment sales are strong. And then just talking to resi agents, what they're all saying is, look, there's a lack of supply, and there's pent-up demand. And then there's more people moving back to Ireland, looking to buy. Like you look at Owen Riley's, I'm looking at your screen drop there, and then I'm kind of watching, the demographic of the buyers in the Docklands.
Yeah.
And how you track that, and then a lot of the buyers are expats moving back in, but a lot of them are foreign buyers. But at the same time, you're talking about all the investors that are pulling out of the out of the rental market. Your mom and pops.
We just spoke with Mary Conway of the Irish Property Owners Association, and the sentiment certainly across the rental market has just been getting progressively worse since 2016, with landlords continuing to leave. But I suppose kind of leaving the housing aside for a moment, you're involved in one of the really interesting sectors at the moment, which is so difficult to read and to understand the data on, and that's the hospitality market, because there seems to be almost mixed commentary coming out. So what's your take on kind of bars and restaurants at the moment?
I think it's a tough market. I think what's happened is a lot of people might have gotten through COVID. They might have invested in the property for outside seating. They've gotten through COVID. They're back open. Business is good, but the issue there is running costs and staffing. Your electricity costs are up 30-40%. A lot of them are surviving, but just about. But if they're going to get hit with an extra VAT increase from 9% to 13.5%, it could put real pressure on them. But like generally speaking, I've kind of rented out 3 or 4 cafe units recently. They've all gone well, but it's and good quality operators coming in. But at the same time, it's tough. Like some people in the hospitality industry might have to check their hours. So instead of being open 7 days a week, they might just open Wednesday to Sunday, and that's due to staffing or due to energy costs. So is it worth your while running with all your electricity on? Your cooker.
Yeah.
Once your cooker's on, you could be cooking for one person, you could be cooking for 8 on the same cooker. So I don't know enough about it. I can just see the demand is there. The good operators will survive. But at the same time, will there be a few casualties? I'm starting to see a few more receiverships or liquidations involved now.
And what are your expectations of that market over the next kind of 18 months?
I think what's happening is the yield rate is changing because it's seen as a higher risk. So what might have been a 6% yield might go to 7% yield. So it could be 14-time multiplier. So it's not as attractive an asset class. Some investors might jump into it thinking that they get value now, and then it'll balance its way out as say electricity costs even out over time. There are talks. You get the minister talking about reducing energy costs. Other talks about trying to keep the energy costs down. We'll see how that pans out. But at the moment, it's a tough market.
Yeah, I'm trying to recall the last time we spoke. I know we talked about co-working spaces, and that's an area that's just blooming at the moment. It's right across the country. So what kind of projects are you working on right now, or what are you seeing kind of through your client base?
Well, what I'm seeing is, I suppose, flexible space. It's all about kind of creating that nearly a lot of guys are looking for flexible lease terms. Like your serviced office providers are flying it. They've gone up again. I think it's probably 25% of the market now, as opposed to 15%. Because at a time of uncertainty, you can tie in with a 12-month contract. All your costs are set. So say, for example, a lot of the operators, they might charge €500 per desk. Per person. So straight away that that's €500 per person. That cost won't change. That's tied in for 12 months. If the market changes, he can reduce, and it gives that flexibility there. But I think everybody's upping their game in terms of what they're providing. So they're nearly providing a third space. So instead of just your Georgian office, they're providing a Georgian office with a cool breakout area or a cafe or extra facilities or amenities. Like, they have to encourage people back into the office. So it's providing all the extras. It's the extra meeting room space. But it's like that. Some people roll it in and you get your water, your teas, your coffees all included in that. But that's your serviced office space. But then there's more competition coming in. You've Paddy McKillen entering the market. You've other operators coming in, and they're all trying to outdo themselves. It's getting more competitive, but a lot of it's down to location. It's the prime central business districts. Okay, they're opening now in Cork and other areas, and will it go out throughout the country? Probably will, but it's a good solution. Service office space is certainly on the growth. And in terms of flexibility, the other option is flexible lease terms. So before it was a longer term lease, whereas now there's a bit more flexibility. People are getting offered, breaks in year 3 in some cases, which is tying in with what's available in Europe, because there's uncertainty there. A lot of it with the tech market as well. That's kind of driving the market. And then you'll have grey space churn where guys have grey space that they're not using, and then they're more open to doing short term because they might grow back into the space as well. So that'll start coming through a bit more now.
It's a very different marketplace. I was surprised very recently. I spoke to somebody who's looking at kind of a headquarters shift, and I was so surprised to learn that, they're only looking at newly built kind of headquarter spaces that have been developed within the last 5 years. And they were looking at some of these grey spaces that you talk about, the headquarters that are being subleased for a certain amount of time. But they were surprised, and I was surprised to hear that even those developed within the last 5 years are falling short of really the standards you'd expect, in terms of LEED or BREEAM or other standards that I would have assumed every headquarter type space in the office market being delivered over the last 5 years would have just had that almost a standard, but that doesn't appear to be the case.
No, I think what's happened before is that the incentives weren't there, and you weren't forced to do it. Whereas now it's literally box ticking. If you're not bringing excellent, or if your building isn't up to scratch, it'll go further down the list. And then there's always the retrofits, where a building might rent unless it's retrofitted. So a building that could be 20, 25 years old might have to be completely revamped. But it's trying to get that. It's not just it's the workplace wellness with the building as well. So it'll have to be premium excellence. Like this new builds, it could be using EcoSem. They could be generating electricity. It could be geothermal. It could be solar. It's bringing it up. And then it's there's more to it. It's a case of you're planting. Could be pollen on the roof. It could be really cool placemaking. They're just lifting it up. Like I think iProperty are now trying to put a value on placemaking for your common areas, and they're doing a survey with I think it's with Hassel, PRD, and Gell architects. So they're trying to see what's the financial benefit of it, of getting your third space area, like your garden area or your breakout area up to certain standards for the public, for the public.
I hadn't heard about that, and certainly in Ireland, iProperty are really leading the charge in terms of their placemaking. But that would be fantastic if they were putting together the business case for this, because actually then we will see people follow suit beyond kind of the tick in the box exercise that we're seeing for some ESG metrics.
It's trying to quantify it. It's trying to say, okay, if you want a headline rent of €65 a square foot, you need to be upgrading the areas in around the office. You need to be creating an area where the public can go and walk and enjoy spending time. You're giving back to the area, but at the same time, it's the office tenants in the area that benefit from it. It's the residential blocks that benefit from it. So it's just trying to quantify that and see, okay, because we're doing this, we'll end up getting higher rents, or people might want to take a longer lease. They might want to, they might be very happy there, rent longer. So
yeah, I think that's an amazing initiative. Actually, I'm definitely going to watch that one with interest. And I saw in the UK maybe last year or 18 months ago in the build to rent sector, a similar initiative was undertaken where one of the companies actually kind of set out to prove the business case for incorporating some elements of placemaking, but also breaking down the amenities at a micro level, so that you could actually show which you could prioritize the business case for each of the individual amenities. And it was a very compelling study, because actually suddenly it went from these things being nice to have, or this being almost a socially driven initiative, to actually saying, no, this is good for business as well. So it's good business, but it's also good for the occupants. And I know that that's particularly important across the build to rent sector. And in Ireland, I don't think we've gotten to that point. I think we don't have that level of maturity in the marketplace yet, but it's certainly something I'd like to get to.
I suppose we're a smaller market, but we're getting there. We're seeing what people are doing over in London, or seeing what they're doing in the States and trying to implement it here. And then it was the whole impact of lockdown, and then your market, your flexibility here. People were working, maybe four days a week. It could be, Monday or Friday off, and then you're nearly trying to encourage people back into the office. So then you're having to offer the extras. It's your cafe, your breakout areas. Some companies are kind of, you're putting on yoga classes, you're putting on the extra things to encourage the office staff back. Not just the younger staff that need to work there, but more trying to encourage the older staff back. That the guys who have the office at home are getting comfortable working at home. They need to come back into the office. But at the same time, flexibility, working from home, that's here to stay. But it could be your 3-4 day week. But it's here to stay. That's the thing.
And that's a really good note to finish on as well, because I agree with you. I think flexibility, working from home, but actually working from home also bleeds into the co-working spaces in rural and regional areas as well, which I think is a really strong one. So just before we finish up, Robert, I always love chatting to you because you're uniquely across so many different sectors, so you have a view that maybe not many professionals have, that, you know, you're interacting with developers on the residential and different areas within the commercial market as well. What are your expectations, or what are you sensing from your clients for the next year to 18 months?
I think there was a lot of uncertainty. People were holding off on buying development sites towards the end of 22. What they're starting to do is come back and revisit that now. And I think when pricing starts to level off a bit, more clients will jump in. Housing at the moment is predominantly the big interest. In terms of office, it was a bit uncertain, but I think towards, you know, Q3, Q4, there'll be more interest in development land, or more schemes getting pushed through. But at the same time, the planning system has to be fixed, or there has to be a solution to it where it's a bit more streamlined.
Final question, Robert. What does fixed look like for the planning? I mean, you talk about planning having to be fixed. What does fixed even look like?
I suppose
what can be salvaged from what we have?
Well, trying to, ideally, if you could get, you know, good pre-planning engagement, you know, and try and have a realistic timeline where it's not pushing out beyond 18 months, you know, where somebody, you know, has a good indication that if they work with the planners, that ideally they'll be able to get planning within 6 to 12 months. I know most subject to planning deals have an 18-month timeline with a pushback for 6 extra months, but that's 2 years. And that would just put pressure on funding. But look, I'm not in that space. I'm not sure how to fix it. But if there was more pre-planning engagement and like a process that worked with different developers, look, the demand is there. It's just providing that supply for.
Yeah. You're preaching to the choir to me in terms of pre-planning engagement. I've always felt that, you know, particularly as there's been a rise in objections and observations, and essentially more community involvement, which we welcome because planning is a public function, getting the pre-planning engagement right just makes sense at this stage. And I think,
of course it does. And most of the time, a lot of the end users are approved housing bodies. So, you know, I'm on a scheme at the moment, and they're struggling. They're in for 50 units for, I think it's 50 units for Focus Ireland, and they're struggling to get planning for Focus Ireland elderly, you know, through third-party objections, and it's caught up in the planning system. So, you know, it's trying to get that fixed where you're really trying to, you know, bottom it out at the start within realistic timeline, and try and push to get that supply there.
Yeah, it's a difficult time to do it because people are just so angry, and it's difficult to see that getting better within the life of the current government, and even within the life of the likely next government. So,
well, as staff, like, it's like if somebody is looking to rent an apartment now, it's so difficult to rent an apartment. You know, you've put a stop to co-living. You know, that's been banned, but at the same time, there's not enough rental accommodation here. And if you're looking at Ireland and the amount of inward immigration coming into the country, and we can't supply enough apartments for them.
Yeah, and I think Ronan Lyons in the Currency, writing on the Currency, recently said that it's 10,000 units coming to the rental market per year, or per month that we need to keep that turnover functional. So 10 coming to the market, like whether they're new or coming back to the market. But at the moment, I think we've something like, you know, 2,600 or just over 2,500. So yeah, we're drastically below. In terms of policies, are you expecting any policy changes within the next 12 months that are likely to make an impact on housing delivery?
I suppose it's I'm not too sure. I thought there might be something to do with VAT, but I don't see that coming true. But like I suppose it, more so with apartments. I think the state need to get involved with schemes that aren't viable. They're on their way to doing it, but it hasn't started coming in. There's a lot of schemes that at the moment developers are going to hold off on building until the build costs come down. It's just not feasible at the moment, and nobody's going to build for a loss. If you build for a loss, you're out of business. So it's a difficult situation. Is there going to be something done on that? Is it going to be contribution towards each apartment? Something has to be done, because otherwise it won't get built in a lot of cases. So
yeah, I feel like I feel like we've been saying that for a while, that it is something that at some point policymakers are going to have to wake up and see that what they're doing isn't working, and that actually it's going to take some drastic policy changes to turn the ship around as quickly as we need it. But unfortunately, I've been optimistic for too many years now. I'm losing sight of the optimism. But listen, that's probably as many problems as we can tackle in one day. So thank you for being so generous with your time.
No problem.
So that was Robert Colleran of Robert Colleran Consultants, and we need to take a quick break now. Stay tuned.